No, I want to start with you because we haven't gotten a chance to talk to you about it. Last year, with all the tumultuous activity in the fourth quarter, your American Growth Fund still managed to close up by more than 23%.
Right.
That's really impressive.
Well, it's easy. It was easy. Yeah, you go up 46 to the end of September, and then you get the crap kicked out of you to the end of December in the last quarter. So that fourth quarter was difficult. I mean, it didn't matter really what you were in. For sure, but we had some big gains in the beginning part of the year.
Why were you up 46% through September?
You know, a lot of the stuff that we have in the secular growth areas, be it in technology or in healthcare, there's a lot of areas that, are growing very rapidly and seem to be gaining share in healthcare and retail, for example, but certainly in technology as well. And so there's also a bifurcation. I mean, the U.S. market did so much better than the global markets last year. It was very difficult to make any money globally last year, but the U.S. Was strong, and we'll see what the earnings season holds. But to me, it looks like the growth is going to continue to a certain extent. The problem is that when you get these big sell-offs like you had in the fourth quarter, the fundamentals of the companies are secondary to everyone's desire to gross down risk, to take things off the table, especially going into year end when everyone's trying to panic. I think we heard that from Citi earlier. Clients were just trying to lock in either gains or minimize losses in the fourth quarter, and you get an exacerbation by year end. But I really don't think it's as bad as the fourth quarter.
And you can't help yourself to measuring things in years, and you really shouldn't. I mean, it's like a CEO measuring himself in quarters.
I've been running 20 years the same fund.
So, but you still feel pressure at the end of the year to lock in certain things, or
I don't, but I have to deal with everybody else.
You have to deal with everyone, because maybe that for setting you up for 2019, maybe December's the best thing that could have happened to set you up for next year, right?
Yeah, I mean, if
this year,
if the Fed has actually, if they've done their mea culpa, I think they blinked finally, and they're probably on hold for the first half and probably all of 19. And I think they were the main cause of this fourth quarter sell-off.
So it's the American, what's it called?
Dynamic Power American Growth Fund.
You didn't even think about it making it the Dynamic Powerful Canadian Growth Fund, did you? You're up in Toronto and you're down here buying all our stuff. Is that the way to?
You're welcome.
Yeah.
Ryan, let's talk about that. You look around the globe and you think that everybody else, the rest of the markets around the globe, are on sale by comparison. Is that where you're telling people to put their money right now?
Yeah, I feel like a kid in a candy store right now, and no, you might feel the same way. Things just sold off so grossly in December that you just have to look at the global markets, and if you look at valuations overseas, they're even cheaper than the U.S. right now. You're getting dividend yields of over 4%, and then you look at growth rates around the world at maybe close to 3% this year. I think you just have to think globally right now when you're putting money to work in your portfolio. You can't just be U.S.-centric.
Do you agree with that or not, Noah?
I don't know. If you look around the globe, I'd say that you look at, we've been big investors in China for a long period of time. A lot of people, I think, attribute the weakness in China to the trade and tariff war. That's somewhat true, but they're missing a whole piece of the China story, which was the regulatory environment last year, whether it was on video games or after-school education or healthcare. The regulations, every day I walked into the office, there was more regulations of industry in China like I've never really seen before in all my years of investing there. So the government really cracked down on business very hard at the same time they were in a trade war. And then I look at Europe, fiscal policy doesn't work. You need tax incentives in Europe. You need capital formation. You've brought in 1 million workers at economies growing less than 2%. You need the tax incentives, and I don't really see any sort of regulatory relief or incentives in Europe right now. Sure, there are one-off or two-off companies, but we need to move away from monetary policy and maybe get some fiscal stimulus, certainly in Europe. China is starting, that's for sure.
I think you'd be right about that, but to some extent, let's face it, a lot of that's got to be priced in at this point. You're looking at emerging markets specifically, they're trading out like a 27% discount to the rest of the world, which is cheaper than normally is. I have to think at this point, there's got to be some value there because, no, you know that, I know that, the rest of the world knows that.
China's about 40% of the emerging markets index, and if the stimulus goes through and if the regulatory regime is paused, then yeah, the EM could work well. If the Fed is paused and they get some dollar relief, that could drive that too. But what's the case for Europe?
You have record unemployment, for it's the lowest in 10 years. And again, I just think looking at valuations overseas, with GDP has grown at 22 quarters in a row. It's not all bad, and I think the headline risk right now is probably weighing on prices more than the actual economies overseas.